Imagine a massive, sprawling construction site. Right now, in the global technology sector, people are staring at the old, familiar buildings, the social media apps and consumer platforms that dominate our daily lives, and they are completely missing the fact that the foundation of the entire city is being ripped up and replaced. While retail investors are distracted by falling user numbers on dating apps and social platforms, the smartest money in the world is quietly executing a multi-billion-dollar wealth transfer, pouring concrete and steel into the invisible infrastructure of artificial intelligence. If you are not paying attention to who is building these new skyscrapers, you are going to be left behind in what might be the greatest financial recalibration of our generation. Hello, this is Warm Insight. Today we're going to talk about the immense bifurcation of the tech sector, the dominance of AI infrastructure, and the evolving software paradigms that are rewriting the rules of wealth creation. Leaving a like and subscribing is a huge help to us to truly grasp the magnitude of what is happening right now in the financial markets. We have to look past the sensational headlines about chatbots and viral videos. We need to look at the metal, the silicon, and the sheer power required to make artificial intelligence actually work. The global tech macro environment is unequivocally dominated by the accelerating AI revolution. But this is not a software story anymore. It is a hardware story. It is an infrastructure story. Let us travel back in time for a moment to the mid-19th century, to the famous California gold rush of 1849. Hundreds of thousands of people left their homes, risking their lives, traveling across treacherous terrain with dreams of striking it rich by panning for gold. A few of them did get lucky, but the vast majority ended up broke, exhausted, and destitute. The people who actually built massive generational wealth during the gold rush were not the miners. They were the merchants. They were the people selling the picks, the shovels, the tents, and the Levi Strauss denim jeans. They understood a fundamental economic truth. In a gold rush, do not bet on the gold. Bet on the infrastructure required to get it. Today, artificial intelligence is the new gold, and companies like Micron and Supermicro are the ones selling the digital pickaxes and shovels. We are seeing market capitalizations explode, with Micron surpassing $700 billion. This is being driven by an absolute insatiable demand for AI memory chips. But what exactly does that mean? Let us break this down. Think of an artificial intelligence model like a master chef working in a massive high-end restaurant. The chef's brain, their ability to create recipes and understand flavors, is like the computing processor. But even the greatest chef in the world cannot cook a meal if they do not have any counter space to chop vegetables, mix ingredients, and stage the plates. Memory chips, like the ones Micron produces, are the digital counter space. The larger and more complex the AI models become, the more counter space they need to process trillions of data points simultaneously. Right now, the world is demanding infinitely more counter space, and there are only a handful of companies capable of building it. This is not merely a cyclical uptick, where things go up and down with the seasons. It represents a fundamental structural shift in the global technology stack. The physical infrastructure underpinning AI has become a critical strategic asset, much like oil or steel in the 20th century. And this infrastructure boom is heavily tied to intense geopolitical competition. The push for localized manufacturing, as evidenced by Supermicro's progress in expanding United States operations, reflects broader national security and supply chain resilience objectives. Nations are realizing that relying on overseas supply chains for the very foundation of the future economy is a massive vulnerability. It is like outsourcing the production of your nation's water pipes to a rival country. You simply cannot do it if you want to remain secure. This geopolitical tension is amplifying the investment appeal of domestic tech production, making these infrastructure companies not just corporate giants, but pillars of national defense. While the hardware companies are laying the physical foundation, we are also seeing a massive shift in how software is being built and funded. Capital is increasingly flowing into foundational AI capabilities and enterprise software solutions, moving rapidly away from consumer-facing toys. Take SAP, for example. This is an established enterprise software giant. They recently made a staggering $1.16 billion investment in an 18-month-old AI lab. Why would a massive legacy corporation throw over $1 billion at a startup? That is barely a year and a half old. To understand this, think about how large corporations operate. A global company is like a massive, sprawling city. It has logistics, human resources, finance, supply chains, and customer data all flowing constantly. Historically, managing this city required thousands of human workers manually moving data from one silo to another. Enterprise software is the nervous system of this corporate city. What SAP and other giants realize is that integrating artificial intelligence into this nervous system will unlock unprecedented efficiencies. It will automate the mundane, predict supply chain bottlenecks before they happen, and analyze complex data environments in milliseconds. This is not about generating a funny poem or a synthetic image. This is about deep structural productivity gains. It is a global race to maintain competitive advantage, accelerate research and development, and secure future economic growth. This specialization goes even deeper. Consider investments in companies like Altara, which focuses on bridging data gaps in specialized fields, like the physical sciences. General-purpose AI models are great for everyday tasks, but they fail when it comes to highly complex, specialized domains. Imagine you are trying to invent a new lightweight metal for aerospace, engineering, or a new chemical compound for a life-saving drug. You cannot rely on a generic chatbot. You need highly specialized vertical AI that understands the fundamental laws of physics and chemistry. This demonstrates that AI's pervasive application extends far beyond what the average consumer interacts with. Smart money is funding the highly technical, often boring-sounding applications that will actually change the physical world. But while the infrastructure and enterprise sectors are experiencing a renaissance, the consumer tech world is facing a reckoning. Let us look at social and consumer platforms. Our data shows user engagement metrics are slipping. Take the dating app Bumble, for instance, which has seen a decline in paying users. This indicates profound challenges with current user engagement models. For the last 15 years, the tech industry was obsessed with the attention economy. The goal was simple: build an app, hijack human psychology, keep people scrolling, and sell their eyeballs to advertisers. It was built on the psychological principles of variable rewards, much like a slot machine in a casino. Every time you swipe or pull to refresh, you get a tiny hit of dopamine. But human biology has its limits. We only have 24 hours in a day, and consumer fatigue is setting in. People are becoming numb to the digital slot machines. Imagine a massive party that has been going on for a decade. The music is loud, the drinks are flowing, but eventually people get tired. They start to leave early. The hosts of the party, the social media companies, are frantically trying to play louder music and flash brighter lights. But the fundamental appeal is fading. The real economic engine has moved out of the party and into the factory next door, where the AI infrastructure is being built. This brings us to a critical danger in the current market environment: the herd mentality. The current tech narrative is heavily influenced by sensational headlines of surging stock prices and massive AI investments. This risks fostering a classic herd mentality among retail investors. We have all felt it. The fear of missing out, or FOMO. It is a powerful psychological driver. When retail investors, everyday people managing their own retirement accounts, see news bites about zooming market caps, or an 18% jump in a single day, human nature takes over. They see their neighbor making money. They see influencers bragging about their gains, and they rush to buy. This is the exact same psychological phenomenon that drove the tulip mania in the 1600s, where people traded their life savings for a single flower bulb. It is what drove the dot-com bubble of the late 1990s, where any company with a .com at the end of its name saw its stock price skyrocket, regardless of whether it actually made any money. The sheer volume of AI-related news, from groundbreaking advancements to high-profile legal battles, contributes to a perception of an unstoppable, uniformly positive trend. This blinds less sophisticated investors to the nuances of risk, valuation, and potential market corrections. They end up buying at the absolute peak, right before the smart money cashes out. And what exactly is the smart money doing? They are acting as contrarians. While the mainstream narrative fixates on generative AI's explosive growth in hardware giants, the smartest institutional investors are making calculated, often counterintuitive moves. For instance, look at the venture capital firm Andreessen Horowitz, commonly known as A16s, and their steadfast commitment to their crypto fund. Despite a broader cooling in the cryptocurrency market and endless media declarations that crypto is dead, they are staying the course. Why? Because they understand the difference between a hype cycle and a foundational technological shift. They view blockchain technology not as a way to trade digital dog coins, but as a critical long-term trust layer for the internet. As AI generates infinite amounts of synthetic content, proving what is real and what is human will require decentralized cryptographic ledgers. This indicates a strategic differentiation. Smart money recognizes that distinct technological paradigm shifts, while perhaps out of the daily headlines, continue to offer significant future value. They are not just chasing the loudest stories. They are discerning which specific segments offer sustainable competitive advantages. So how do we navigate this bifurcated, highly volatile landscape? We must look at both the institutional bull case and the institutional bear case. The bullish scenario is exceptionally strong. It is driven by relentless innovation and escalating adoption within AI infrastructure. We anticipate a profound and sustained demand for advanced semiconductors, high-performance cloud computing services, and sophisticated data analytics platforms. This shift will propel the valuations of established tech giants and create fertile ground for agile startups. The efficiency gains and productivity enhancements, promised by widespread AI integration, are set to unlock entirely new revenue streams and expand profit margins across the broader economy. This provides a powerful, long-term tailwind for the entire tech ecosystem. However, we must respect the bear case. The bearish perspective hinges on critical vulnerabilities, including potential overvaluation in certain AI segments, and the risk of a massive hype cycle bust. If too much capital floods into foundational AI too quickly, it could lead to a crowded market, diminishing returns for late entrants, and a wave of mergers and acquisitions that destroy shareholder value. Furthermore, if the consumer-facing social platforms continue to struggle, it could signal broader user engagement, fatigue that spills over into the broader economy. Combine this with the risk of an unexpected economic downturn, persistent inflation, or a significant rise in interest rates, and growth-dependent tech valuations become extremely vulnerable. Higher interest rates act like gravity on stock prices, pulling them down as the cost of borrowing money increases. The sector is particularly susceptible to sharp corrections as investors de-risk their portfolios and shift towards safer defensive assets, exposing the speculative froth in parts of the market. To survive and thrive in this environment, we must utilize the Titan's playbook. Rule number 1 is understanding the generational bargain. Current market sentiment is precariously balanced. It leans heavily towards greed in specific high-growth AI infrastructure segments, yet harbors underlying fear regarding broader economic stability. The narrative of AI as a transformative force is undeniably strong, pushing valuations to historical highs. However, beneath this enthusiasm, there is palpable anxiety about regulatory intervention and geopolitical tensions. This bifurcation means investors are selectively pouring money into perceived winners, while remaining highly sensitive to negative news. Sentiment can swing rapidly from exuberant optimism to cautious retreat in a matter of hours. Rule number 2 is the asset allocation seesaw. Capital deployment now demands a highly selective approach. We recommend a 70-20-10 allocation. 70% in high-conviction stocks, 20% in safe, defensive assets, and 10% in pure cash to deploy during major market panics. Within that stock allocation, the focus must be on tangible growth, drivers, and strong competitive moats. We favor overweighting semiconductor exchange-traded funds, or ETFs. Think of an ETF like a beautifully arranged fruit basket. Instead of betting your entire life savings on one single apple, that might turn out to be rotten. You buy a basket containing slices of every apple, orange and banana in the orchard. By buying semiconductor and cloud computing ETFs, you are investing in the indispensable backbone of the AI revolution. Without taking on single company risk, you are buying the entire infrastructure layer. Rule number 3 is the global shield. For optimal tech exposure, the strategic focus should largely remain on companies domiciled in the United States. The U.S. continues to lead globally in foundational AI research, venture capital funding, and the development of next-generation cloud infrastructure. While there are burgeoning tech hubs internationally, their scale, depth of innovation, and market access often lag behind their American counterparts. International exposure should be highly selective, targeting specific companies with clear defensible advantages in niche areas. Finally, rule number 4 is survival mechanics. In a highly dynamic tech environment, dollar cost averaging, or DCA, and robust risk management are paramount. Dollar cost averaging is the ultimate defense against human emotion. Imagine you have a massive tank of water you need to pour into a swimming pool. If you dump it all in at once, you create a massive, violent wave. If you dump it in at the wrong time, you cause chaos. But if you connect a hose and let the water flow, in slowly and steadily over several months, the water level rises smoothly. DCA works the same way. By spreading your purchases over time, buying a set dollar amount every week or every month, regardless of what the stock market is doing, you mitigate the risk of buying right before a massive crash. You acquire shares at an average price, smoothing out the market's violent fluctuations. Concurrently, you must maintain discipline. Avoid chasing speculative meme stocks or unproven AI concept companies solely based on hype. Do not buy a stock just because a stranger on the internet used rocket ship emojis. Focus on underlying business models, real revenue generation, and defensible competitive advantages. The true power of technological transformation lies not in fleeting trends, but in the foundational shifts that redefine productivity and create enduring value. History consistently shows that periods of profound technological advancement are accompanied by both exhilarating growth and speculative excesses. Astute investors who focus on the underlying infrastructure, rather than just the most visible consumer applications, are the ones who consistently reap the greatest long-term rewards. We couldn't fit all the deep dive details and practical strategies into this video. Check out the Warm Insight newsletter in the pinned comment and description for the full text summary. Visit www.warminsight.com. See you there.